Your next guest says that it's time to get defensive and brace for what he calls a sloppy summer. Let's bring in Steve Chiavarone. He is portfolio manager and equity strategist at Federated Investors. Steve, good to see you again.
Brian, it's nice to see you in the daylight.
It is really. It's nice to see me in the daylight as well. Here's the thing, though, okay? This is, as we just noted, a market which has got so many things going on that seem a little, to Karen's point, weird, right? There's a lot of confluences that are happening that you normally don't see together. As a fund manager, how do you manage through this? Is it more cash? Are you buying utilities?
I don't think you change your stock bond call here down 5%. And the reason why is we view trade as being a 5 to 10% event, not taking us back to the December lows, because in December you had the Fed on the wrong side of things, you had economic data in free fall, and earnings estimates were rolling over, and none of those are in place today. However, within your equity allocation, we think there's things you can do to be more defensive. So you talked about dividend plays. Look, the 10-year went from 3.25 to 2.3. That benefits those parts of the market. They're a little bit less volatile, when you have this kind of volatility over the summer. But there's some areas that have actually gotten beaten up that might have some opportunities as well. So we talk about small caps, which sounds ridiculous because you say these are the most cyclical of names. But 50% of their funding is variable rate bank debt. So when the 10-year yield goes from 3.25 to 2.25, that's a direct improvement in their cash flow. And we think that considering that they're down 5% so far this year, with the S&P down 3%, there's a little bit of an opportunity there. And we also think, look, you've got over 50% of the S&P 500, 10% or more below its 52-week size. Put together your list of favorite names. Look, if it's Alphabet, fine. If it's the semiconductors, which I know Chris Rohn's going to talk about later, put together your list and start picking away when you think that these things have gotten overdone, because we don't think that you have the end of the bull market run here. We just think that you've got a difficult and sloppy summer where the upside's capped and the downside is a little bit as well.
Well, Steve, I listened to you talk about, though, President Trump and Xi are in an endurance test, as you say, on some level. That doesn't sound like something that's going to end anytime soon. We set up this show. Karen talked about damage that may not be transitory. You have a dynamic here where I think the leading indicators, if you look at business confidence, if you listen to CEOs, they're retrenching at a time when even if you get a trade deal, as we've kind of seen even with that global synchronized growth, even when we actually thought we were getting a trade deal 3 months ago, it's not like you went back to the races again. And if anything, you've seen the weaker players like Europe, like some parts of Asia, like emerging markets, look at EM currencies, tell you it's not going to be an easy road back.
Tim, I think when you take a step back, what's happening on trade is the U.S. and China are negotiating terms of coexistence. You have an ascendant economic power and an established one. And the terms that the U.S. has offered so far is, look, you either allow us to protect our intellectual property and we're complementary economies that grow together, or we're going to try to crush you. And when the president ripped up the red line edits from the Chinese the other day, he killed the market consensus, which was that he was going to take a soybean deal. And what he did was he automatically increased the odds of a substantive deal and no deal at the same time. And so I think what you're dealing with now is more risk to the downside if something doesn't get done, but more upside if a deal actually takes place, because it's not going to be a nothing deal. Ultimately, when you buy a stock, you're buying the future earnings of that company discounted back. If we protect our intellectual property, that's a better bet to buy. So if this actually does lead to a deal, which is our base case, this could all be worth it.
Let me ask you, you talk about small caps, or Russell 2000 as a defensive. I think of that as more of an aggressive, right? They're smaller companies that tend to be able to not withstand some of the macro events as well.
So I think there's two themes here that we're trying to play on. The first one is that you've got this sloppy summer, as we call it, to give it a kind of cute term. But then we think that the economy is stabilizing and can reaccelerate in the back half of the year, and there's some cyclicality to those names. They've underperformed a little bit, and they're more rate sensitive than you think. So they benefit from the lower rates. They can rebound, and we think that combination, you may have some time, but it'll end up working.
Steve Chiavarone, a really good discussion there. Steve, we'll see you soon. Thank you very much. Federated Investors. All right, so guys, let's trade that talk. I mean, is everybody can pile into utilities, Guy, and then all of a sudden you're trading at 20 times forward earnings on a regulated utility. That doesn't work.
Doesn't make any sense at all.
No.
No, and I think to my comment at the top of the show, I think that's problematic. I think people are looking in the wrong place. Steve mentioned the Russell, and let's just play the devil's advocate real quick. The IWM, the Russell 2000, that topped out with the S&P in the fall around 175, fell off a cliff like everything else. But the rally back did not trade on par with the S&P. As a matter of fact, We didn't get anywhere close to where it should have been if it traded with the S&P 500. To me, and I think to Karen's point, I think that sort of bodes for further downside in the IWM, which to me leads the S&P lower as well.
I think it's dangerous to be running into consumer staples and utilities with valuations that make no sense. So I'm not a believer in Procter & Gamble at these levels. I'm not a believer in Clorox. I'm not a believer in a lot of these names that really have difficult justifications for valuations here. If we go into a serious growth period, I think what we've seen is during periods where you've actually been kind of sideways in terms of expectations, you've had an ability to trade at a higher multiple for the S&P.
Just quickly, Dan,
I don't see that.
Do you think we get a rate cut this year?
Yeah, it seems very likely.
There's a 50% chance we're 50 basis points lower by January, according to Fed Funds futures right now.
50 for 50 basis
50
points.
for 50. So a half a point by January is half the market's bet right now.
Well, then you got to think a chance of a 25 point is higher than that.
86%.
Fed cutting twice is not good news, no matter how you slice this.
All right.